There's a lie being told in the finance world that you need thousands of dollars to start investing. You wait until you have $5,000, $10,000, maybe even more. That decision could cost you over $100,000 in lost growth. Because compounding isn't a rich person's strategy. It's a mathematical principle. And in 2026, if you aren't using it, time is actively working against you. Let's compare two people, Alex and Sam. Alex starts investing at age 20. He puts in just $200 a month, no big salary, no inheritance, just consistency. He does this for 10 years, then stops completely at age 30. He never adds another cent after that. Total amount he personally invested? Just $24,000. Now Sam takes a different path. He wants to enjoy his 20s, so he waits and starts at age 35. But he goes much bigger. He invests $600 a month, triple what Alex ever did, and he keeps it up for 30 full years until retirement at 65. Total amount Sam personally invested? $216,000. So who comes out ahead? Assuming a 7% average annual return, which is a realistic, historically grounded estimate based on long-term stock market performance after adjusting for inflation, here's what happens. Alex, who invested only $24,000 and stopped 35 years before retirement, ends up with approximately $1.1 million. Sam, who invested $216,000 over 30 dedicated years, ends up with approximately $910,000. Sam invested 9 times more money than Alex. He worked 3 times longer, yet he still ended up with less. Why? Because Alex bought something money can't easily replace: time. Sam tried to buy back time with larger contributions. In personal finance, that is a trade you almost always lose because the early years of compounding are where the real magic happens. The first decade of growth sets the foundation that everything else builds on. So what's the minimum you actually need to start? It's not $1,000. It's not even $500. It's simply the amount you can invest consistently today without disrupting your daily life. Whether that's $100 a month or $50 a month, compounding doesn't care about the size of the contribution. It cares about how many years that money has to grow. At 7% average annual returns, your money doubles roughly every 10 years. It starts slow, almost invisible. But in the final decade before retirement, the growth becomes dramatic. A $200,000 portfolio growing at 7% adds $14,000 in a single year without you lifting a finger. That's your money working for you, not the other way around. In 2026, starting is easier than ever. You can buy fractional shares of major companies for as little as $1. You can set up automatic investing tied to your payday so you never even see the money leave. Index funds give you instant diversification with zero stock picking required. The barrier to entry has never been lower. The only real barrier left is hesitation. Let's make this personal. If you're 25 watching this, you are sitting on one of the most valuable assets in existence. Time. Protect it. If you're 35, starting today still puts you decades ahead of starting tomorrow. The math still works in your favor. If you're 45, consistent investing from this point forward can still build serious wealth by retirement. It's harder, but absolutely possible. Time is either your greatest asset or your most expensive mistake. I want to help you see your own numbers. Drop your age in the comments. I'll reply and show you what $100 a month could realistically grow to by retirement. The results are genuinely surprising. Start with $100. Start with $50. Just start. Because once that compounding snowball is rolling, your only job is to protect it and stay consistent. And if you want to make sure hidden fees and unnecessary middlemen aren't quietly eating into your returns, watch the next video. Because that's a problem nobody warns you about until it's too late. See you there.